There's a number sitting in your bank account right now, and the day your balance or your activity crosses certain invisible lines, something changes that nobody at the bank will ever sit down and explain to you. Your account starts generating reports. Reports that travel to a federal agency most Americans couldn't name if you put a gun to their head. And the moment one of those reports gets filed, the bank is, in many cases, legally forbidden from telling you it happened. There's a specific dollar amount that triggers an automatic report the instant you cross it. There's a second kind of report that has no dollar amount at all. It can be filed on a transaction as small as a couple $100s. And there's a newer reason, one that's grown sharply in the last few years, that banks are quietly pulling seniors into a side office and putting a hold on their own money for days at a stretch. Now, here's the part that catches good, honest people completely off guard. For almost everyone watching this, the reports themselves are harmless. They're routine. They go nowhere. Nobody calls. Nobody knocks. The thing that actually destroys retirees isn't the report. It's what they do the very second they find out the rule exists. Because the reaction that feels the safest, the most cautious, the most responsible thing you could possibly do is the one move that can turn a lifetime of clean legal savings into a federal investigation. I'm Henry, and on the Henry Wealth Blueprint, I walk through the things the system is happy to let you not understand. Today, I'm giving you 7 things about your own bank account that no teller, no banker, and no government letter will ever explain to you on their own. Every single one is real. Every single one is happening right now in 2026. And the 7th one, the last move, is the quiet mistake that costs families more money than the other 6 combined, and almost nobody sees it coming until it's far too late. Stay with me all the way to the end because the fix I'm going to hand you takes about 10 minutes at your branch, costs you nothing, and protects nearly everything you've spent your entire life building. Let's start. Number 1 is the $10,000 rule, and before you can stop being scared of it, you have to actually understand what it is, because almost everyone gets it wrong. There's a law called the Bank Secrecy Act. It's been on the books since 1970, longer than most of us have had a checking account. Under that law, every bank and every credit union in the United States is required to file a report anytime you deposit or withdraw more than $10,000 in cash in a single business day. That report has a name. It's called a currency transaction report. And here's the first thing that surprises people. It does not go to the IRS. It goes to a bureau inside the Treasury Department called the Financial Crimes Enforcement Network. You'll hear it called FinCEN. The bank files it, not you. You don't sign anything. You don't fill out a form. You will very likely never even know it happened. The bank has a window of time to send it in, and it keeps a copy on record for years. This happens millions of times a year in this country, and the overwhelming majority of those reports go absolutely nowhere. Nobody investigates you. Nobody freezes a dime. A currency transaction report is not an accusation. It is not an audit. It is paperwork. If you sell a used truck for $12,000 in cash and you carry it into your bank and deposit the whole thing, a report gets filed and your life does not change in any way. I need you to really hold on to that because the next thing I'm going to tell you is exactly where good people walk straight off a cliff. Number 2 is the single most dangerous decision a retiree can make with their own money, and it's so dangerous precisely because it feels so smart. Here's what happens. Somebody hears about the $10,000 rule for the very first time, and almost everyone's brain goes to the exact same place. They think, fine, I'll just deposit $9,000, or I'll bring it in a few thousand at a time over a couple of days. Stay under the line, avoid the whole headache. That decision, deliberately keeping your deposits below the reporting threshold, has a name. It's called structuring, and under federal law, it is a felony. Not a fee, not a stern letter, a federal crime. And here is the part that is genuinely cruel. The money does not have to be dirty. You don't have to be hiding a single thing. Every dollar can be perfectly legal. Your own savings, an inheritance from your parents, a gift from your own grown children. And if you intentionally break it into smaller pieces just to dodge the report, you have broken the law. The act of trying to be careful is the crime. The consequences are severe. We're talking years in federal prison and fines that can run into the hundreds of thousands of dollars. And on top of that, the government has the power to seize the money itself through a process that doesn't even require them to charge you with anything first. There are documented cases, real people, small business owners, widows, ordinary retirees, who watch their entire life savings get taken, even though the money was completely clean, simply because their deposits formed a pattern that looked like someone trying to stay under the line. So here's your rule, and it's simple. Deposit your money all at once, every dollar of it in one transaction, and keep a record of where it came from. The bill of sale, the inheritance paperwork, whatever it is. The report that gets filed is harmless. The breaking it up is what turns honest money into a federal case. Now you'd think the $10,000 line is the only trigger to worry about. It isn't. And the next one doesn't have a line at all. Number 3 is the report with no limit whatsoever, and most people have never heard it exists. On top of that $10,000 currency transaction report, there's a completely separate one called a suspicious activity report. And this one has no floor, none. A bank can file a suspicious activity report on a transaction of $500, $200, any amount at all, if the activity looks unusual to the software that monitors every single account around the clock. And here's the chilling part. It is a federal crime for a bank employee to tell you that one has been filed about you, so you could be flagged this week and have no way of ever finding out. What triggers it is not the size of the money, it's a change in your pattern. If you've quietly withdrawn $300 a week for the last 15 years, and one day you walk in and ask for $9,000 to pay a contractor, the system notices the deviation. It doesn't know you're replacing your furnace. It doesn't care. It flags anything that looks different from your history, anything that lands on suspiciously round numbers, and any deposit that doesn't line up with what the bank thinks it knows about your income. This is exactly why you never want to walk in cold with an unexpected stack of cash and no story. The cure is almost insultingly simple. Bring the paperwork that proves where the money came from or where it's going, and the flag quietly resolves itself in the background. The software flagged a stranger. You showed up as a person with an explanation. But there's a newer flag, one written specifically with seniors in mind, and it's the reason you may have heard stories about frozen accounts. Number 4 is the newest one, and it's the reason your friends may be whispering about banks freezing senior accounts. In recent years, banks and brokerages have been given the authority to place a temporary hold on the account of anyone 65 or older the moment they suspect that person is being financially exploited. The hold can last a couple of weeks, and under certain circumstances, it can be extended even longer. Now, this rule was written with genuinely good intentions. The goal was to stop a scammer from draining a grandmother's savings before her family ever noticed something was wrong. That's a worthy goal. But the very same rule means a completely sharp, clear-headed retiree who walks in to withdraw $20,000 to help a grandchild with a down payment can get pulled into a private office, questioned about who the money is really for, asked whether anyone instructed them to make the withdrawal, and told to wait while the bank decides whether to release their own money. There is no age at which the bank stops treating a large withdrawal as a possible scam, and arguing with the teller does not speed anything up. If anything, getting agitated makes it worse because distress is one of the things the training tells them to watch for. Here's how you stay completely ahead of this. Tell your bank before the big transaction, not during it. If you know a large withdrawal is coming, call the branch ahead of time, let them make a note on your account, and ask to name a trusted contact. A person the bank is allowed to call to verify things are fine. That one phone call turns what could have been a multi-day freeze into a 5-minute conversation where they hand you your money and wish you a good day. So far, we've covered the things that watch you. The next one is about something watching out for you, except most seniors have never actually checked it. Number 5 is the $250,000 line, and unlike the others, this one isn't about punishment. It's about protection. Protection most people assume they have and have never once verified. Every account at every bank in this country is insured by the Federal Deposit Insurance Corporation, the FDIC. You've seen the sticker on the door. But here's the part nobody reads. That insurance only covers you up to $250,000 per depositor, per bank, per ownership category. So if you have $300,000 sitting in one account at one bank and that bank fails, $50,000 of it is simply not insured. It can be gone for good. Now I can already hear it. Henry, banks don't fail anymore. That's Great Depression stuff. I wish that were true. Just a couple of years ago, in 2023, this country watched several of the largest bank failures in its entire history unfold within the span of a few weeks. The depositors who were under the insurance limit were fully protected, every penny. The people who were over the limit were exposed, and the only reason many of them were made whole was an emergency political decision. And there is no law anywhere that forces anyone to make that same decision the next time. If you are holding more than $250,000 in a single bank, the solution is easy and it costs you nothing. You can spread it across more than one bank, or you can use different ownership categories at the same bank to multiply your coverage. Either way, you bring every single dollar back under the umbrella. No more exposure, no more gambling on a political rescue. And once you've made your money safe, there's one more thing standing between you and a disaster, and it's the one that breaks my heart the most because it's almost always done out of pure love. Number 6 is the quiet mistake I promised you at the very beginning, the one that costs families more than all the others combined. And here's the painful part. It almost always starts with someone trying to do the right thing. At some point, a well-meaning friend or even a banker tells a widow or a widower that the simplest thing to do is add one of the kids to the bank account. That way, the child can help pay the bills, and the money passes to them easily when the time comes. It sounds completely reasonable. It sounds like good planning. It is one of the most dangerous things you can do with your money. Here's why. The moment you add your son or your daughter as a joint owner of your account, that money is legally half theirs, not when you pass. Right now, today. And that means the money is now exposed to everything that touches their life. If that child goes through a divorce, your account can be dragged into the property fight. If that child gets sued or causes a serious car accident or falls behind on taxes or files for bankruptcy, a creditor can reach into your account, because your child legally owns a piece of it. Any one child you add can legally walk in and withdraw every last dollar without asking the others. And I have watched that single fact tear families apart after a parent is gone, turning siblings into strangers at the funeral. It gets worse. A joint account can disrupt your ability to qualify for Medicaid if you ever need long-term care. It can create gift tax complications. And here's the one that stuns people. It can quietly override your entire will. Because a joint account usually passes straight to the surviving owner the moment you die, no matter what your will says. You could spend money on an attorney to write a beautiful, fair will dividing everything equally among 4 children, and a single joint account hands the whole thing to one of them. The thing that was supposed to make life simpler ends up handing your life savings to a lawsuit, an ex-spouse, or one child instead of all of them. Now, there is a fix, a simple one, and it's the 10-minute move I told you to wait for at the very start of this video. Number 7 is the answer to almost everything we've talked about today, and it's been sitting at your bank this whole time waiting for you to walk in and ask for it by name. Instead of adding a child as a joint owner, you ask your bank for something called a payable on death designation, a POD. Some banks call it a beneficiary designation. Here's what it does. You stay the one and only owner of that account for the rest of your life. Your children have no access and no ownership while you're alive, which means no creditor of theirs can touch it, no divorce can reach it, no lawsuit can pull it in. It's yours completely. But the moment you pass away, the account goes directly to the people you named. Immediately, without going through probate, without a courtroom, without an attorney's bill eating into it. It does everything people wrongly believe a joint account does with absolutely none of the danger. It's free to set up, and it takes one short conversation at your branch. And while you're sitting there having that conversation, fix the amount too. The honest answer to how much money belongs in an ordinary checking or savings account is roughly 3 to 6 months of your living expenses. For most retirees, that lands somewhere in the neighborhood of $15,000 to $25,000, and not a great deal more. Everything you keep above that is being watched more closely. It's earning you almost nothing, and it's quietly losing ground to inflation every single month it sits there. So move the rest in your own name, keeping full control the entire time. You can put it into a high-yield savings account paying around 4%. You can buy treasury bills or savings bonds directly from the government through a website called Treasury Direct, backed by the full faith of the United States, or you can ladder it into certificates of deposit spread across several banks, so every dollar stays under that insurance limit we talked about. You keep complete access, you keep complete control, and you finally start earning real money on savings that used to just sit there, exposed and earning nothing. Let me pull all 7 of these together, because there's a single thread running through every one of them, and once you see it, you can never unsee it. The $10,000 report exists, and the bank will never explain it to you. The structuring law can punish you for the simple act of trying to be careful. The suspicious activity report can be filed on any amount at all, and you'll never be told. The bank can freeze your own money for days in the name of protecting you. The insurance only covers you up to a line you've probably never once checked. And the joint account you set up out of nothing but love can hand your life savings to exactly the wrong person. Here's the thread. None of this ever comes looking for you. The bank does not call to lower your risk. The government does not mail you a letter explaining how to keep your money safe. The entire system is built so that everything stays exactly where it is, quiet, exposed, and working against you, right up until the day you decide to stand up and move first. And now you know. You know where the line is. You know exactly what not to do the moment you cross it. You know the one designation that protects nearly everything you own. The only thing left to do is walk in and ask for it. So let me ask one thing of you. Think of one person over 60 who keeps most of their savings sitting in a single bank account. Your mother, your father, your older sister, the neighbor down the street, the friend from church who just lost a husband or a wife and is about to add one of the kids to the account this week because somebody told them it was the easy thing to do. Send this to them. The odds are honestly very good that at least one of these 7 things is quietly putting their money at risk right this minute. And one message from you could save them thousands of dollars and a freeze they'd never even see coming. That's the whole reason I do this. I'm Henry. This is the Henry Wealth Blueprint, and I'll see you in the next one.